Hello and welcome to Fed Tax 101. In this episode, we're going to discuss a method of accounting used by many businesses, the accrual method. The accrual method is a core component of federal tax law. Choosing your accounting method and applying it correctly is one of the most important steps in accurately computing this year's tax liability. Your accounting method is the way you make sure you correctly identify the tax year in which you have to treat something as income, as well as the year in which you can deduct the related expenses. Ideally, both of those amounts end up on the same tax return, enhancing your ability to clearly reflect how much of a given dollar is a non-taxable return of your original investment and how much is a taxable addition to your wealth. If you haven't already, you may want to take a look at the Fed Tax 101 episode discussing the clear reflection of income requirement. That episode introduces the importance of accounting methods in trying to match up gross income with related costs and provides important background for today's discussion. But now, let's take that earlier discussion a step further and begin talking about specific accounting methods. Most businesses use as their overall method of accounting either 1. The cash receipts and disbursements method, normally just called the cash method, or 2. An accrual method. Many businesses, especially larger businesses, as well as those that produce or sell merchandise, typically use an accrual method. The cash method is more typically used by individuals, by relatively small businesses, and certain specific types of service businesses. By and large, the tax code tends to prefer that businesses use an accrual method. The key difference between the accrual method and the cash method, which we'll talk about in another episode, is this. The cash method is very simplistic. One court even called it primal. Under the cash method, you have income only when you actually get paid. You have the cash in hand, with some exceptions. You deduct an expense only when you make an actual payment. Cash in, cash out. Pretty simple for the most part. And that's one reason it's so attractive to smaller businesses. The accrual method is much more abstract. It has nothing to do with when you actually get paid or when you actually make a payment. Instead, the accrual method tends to focus more on your legal rights and obligations. The key here is what's known as the all events test. That test says that you have income or you can deduct an expense as soon as two things have occurred. All the events have occurred that fix your entitlement to the payment or your obligation for the expense, and you're able to reasonably estimate that amount. Turning to the first prong of the all events test, all the facts must have occurred that fix your entitlement to the income or your obligation for the expense. Let's look at an example. The year is 1986. The Supreme Court is asked to consider whether a casino can deduct at the end of the tax year the progressive jackpot shown above a bank of slot machines. The critical fact here is that under state gaming laws, the casino had a legal obligation to pay out whatever that posted amount was. It also had to set the machines so that it was possible for someone to win. So at the stroke of midnight on the last day of the tax year, you could look up at that flashing number above the slot machines. Whatever that number was, the state was going to require the casino to write a check for that amount as soon as someone hit the right combination. The ultimate jackpot would obviously be higher, but the payout would be at least that amount. The IRS said the casino could not claim a deduction until someone actually hit the jackpot. For one thing, you don't know the identity of the eventual winner of the jackpot, so no one is there to claim it. And on top of that, it might be years before anyone wins, if ever. According to the IRS, if you don't know who's going to win it or when, how can you say you have a fixed obligation to make a payment as of the end of that year? The Supreme Court agreed with the taxpayer. In Hughes Properties, the court said the only thing that matters is that as of the stroke of midnight on the last day of the tax year, all the events required to obligate the casino to pay the posted amount had occurred. Nothing else had to happen for the casino to be obligated under state law to write a check for that amount to someone at some time. Because the casino was not using the cash method, it didn't matter that it wasn't handing over an oversized cardboard check to someone right then. The fixed obligation is all that matters under an accrual method, not when or to whom it will be paid. The second prong of the all events test asks a different question. Even if I have a fixed right to payment or a fixed obligation to make a payment, is that amount reasonably determinable? Does the final amount have to be known with 100% certainty down to the penny? No. You just have to know the amount with reasonable accuracy. If you can make a reasonable estimate, you have to treat as income, or you can deduct as an expense, whatever that reasonable estimate is as of the end of this year. And that's the amount you put on this year's return. Once you know the final amount in a future tax year, you make an adjustment on that future year's return to the extent you need to. Now, reasonable, obviously, is one of those weasel words without a black letter definition. As a practical matter, though, in thinking about whether something is reasonable, think about your chances of convincing the IRS, or maybe even a judge, to agree with what you did. In this regard, you're always better off if you can use a commonly accepted methodology. Rely on experts for very technical types of expenses, and as with high school math, always show your work. But what if I can only make a wild guess as to what the amount is as of the end of my tax year? For example, you're already contractually entitled to payment. You know you'll get something for goods or services you've already provided. But the contract price can only be computed using facts not in existence as of the end of this tax year. For example, you agreed with the other party that the contract price will be based upon the spot price of gold as of next July 1. In that case, the all events test is not satisfied as of the end of this year, even though you have a signed contract. Regardless of whether you're the buyer or the seller in that situation, you just have to wait until you can make a reasonable estimate in a later year and report the income or expense on that later year's return. Applying the all events test obviously gets a lot more complicated than we've discussed today. It can challenge even tax professionals who have been at this for many years. We can come up with fact patterns and what ifs all day long with these rules, especially if your practice involves advising businesses. Be sure to explore the many nuances of the all events test in much greater detail. For today's purposes, though, just be aware that if you're using an accrual method of accounting, you cannot deduct an expense or include an item in income until both prongs of the all events test, the fact and the reasonably determinable amount, have been satisfied. Two other critical things to know before we wrap up. These two additional considerations help explain why you have to apply your accounting method separately to items of income and expense, rather than just netting them out and applying an accounting method to that single net number. Basically, the rules for income and expense are not the same. First, before you can deduct a particular expense, you also have to satisfy the economic performance requirement. In the broadest, roughest sense, you cannot deduct an expense until, in addition to the all events test we just talked about, you also make a specific economic change in your position. For some types of liabilities, you have to make actual payment. For others, you have to actually perform services. And there are similar rules for other specific types of transactions, but we'll talk about those another day. The economic performance rules are sufficiently important to justify their own discussion. For now, just be aware that this third requirement is there for expenses. The other point to know is this. Changes made to the tax code in 2017 created a one-way book tax conformity requirement for applying the all events test to income. Under this new rule, the all events test will be deemed to be satisfied with respect to an item of income no later than the year in which you include that same item in your revenue for financial accounting purposes. So, for example, if for book purposes you have to include $100 from a particular contract in revenue for this year, you have to include that same $100 of contract revenue and your taxable income as well, even if, under the rules we just talked about, the all events test is not actually satisfied until a later year. That rule is a one-way street, though. You cannot use it to delay recognizing income later than the tax year in which the all events test really is satisfied, regardless of what books does. Here are a few key cases to help get you started with your own research. Well, that's it for this episode of Fed Tax 101. Keep checking back for more. So long, everyone.